Have you ever asked the question, what would you do? Another way to ask this question is, what would you recommend if you were in my situation? This is one of the best questions to ask your life insurance agent or your financial services professional. Perhaps you're working with an advisor and we're talking about whole life insurance policies designed for maximum cash value. Again, one of the best questions to ask. It can be a challenging question to answer, and the most important thing to answer this question, in my opinion, is empathy. You have to have the ability to put yourself in the other person's shoes, really view things how they're viewing it, and then make a proper recommendation. Because if someone asks me that and I have had zero engagement, zero email correspondence, zero phone calls, don't know you at all, and you ask, hey, what would you do? That'd be like you asking me, hey, what would you recommend for dinner? I recommend pasta because pasta is one of my favorite foods, and you hate pasta. It's not going to work. So we do need information first before we can make a true recommendation. So what we're going to cover in today's video is really the questions and process I'll take someone through before making a recommendation and showing different options. So let's get on into it. The whole purpose of this is if you're interested in a whole life insurance policy, maximum cash value is your goal, and you're trying to find out what's the best option possible for me. What questions should I be asking, or what process can I go through here? So the first set of questions I will ask, number one, with respect to the funding, how much, specifically, how much would you like to pay into the policy? Do you have a certain dollar amount you'd like to add every month, every year? Do you have a lump sum of money? Perhaps you've got $1 million in cash and you're interested in moving some or all of that $1 million into a life insurance policy maximized for cash value, and you want to know the best possible way to do that. Do you write a check for the full $1 million? Do you break that up over 3 or 4 years? What's the best option? So how much do you want to pay in? That's a question I'm going to ask. And this can be a range. If someone is uncertain, I might say, or I would say, this can be a range as well. For example, a lot of times people will approach these policies and state, I know I want the ability to pay up to $100,000 per year. That's the most I ever want to be able to pay into the policy on any given year. But I don't want to get a bill for $100,000. So what I might say is anywhere from, call it $10,000 to $100,000. Because when we design the policy, what that tells me, that response anywhere from 10, or the answer can just be up to $100,000. Now I know we've got to design the policy based on the proper limits that are available, with a MEC limit, that taxable line of $100K, and also a minimum premium that might be around $10,000 per year. But I want to make sure that the product will accommodate payments, you funding, up to $100,000 per year. So this can be a range if unsure, and it often is a range, especially if someone's new to this and they're trying to figure out how much they'd like to pay into the policy. Another question, how long? How long do you want to fund your cash value life insurance policy for? You might say forever, or I want to be able to pay as much money into this product for as long as possible. On the flip side, you might say as short as possible. It's very common to see this both on the individual and corporate level, to take a lump sum of money and they want to move that money into a policy over a span of 5 to 10 years. Meaning after 5 years, call it, I don't want to have to be obligated to pay anything into the policy. So if that's you, I might say, I want to pay in how much? $100,000 per year. How long? For 5 years. Another way to answer this question would be, I want to be able to pay anywhere from $50,000 to $100,000 per year, and I'd like to do that up until the age of 65. I'm presently 40, so that would be 25 years. But getting information on this upfront will help us, or help me, determine the different products and companies that would be best suited based on the dollar amount you'd like to add, and also how long you'd like to pay into the policy. And the product will always be maximized for cash value. Number 3, this is helpful information. Do you have any plans to use the policy? We've got the first bullet point there, growth. Some people just like to move money into a whole life insurance policy because they see the cash value and that it's a safe, liquid, and tax-free area to position money. Tax-free if we don't trigger a MEC or another taxable event. But if I design it properly and it's producing an internal rate of return of 4%, and that's an effective tax-free IRR, assuming again I don't trigger a taxable event, well now all of a sudden if I'm in a high tax bracket, I view that 4% as 6 or 7% that I would have to earn somewhere else. So that can often be very attractive to a lot of individuals when it comes to growth. Just a safe area, I can position money. Oh, and by the way, I have a nice death benefit that is paid income tax-free to my beneficiaries as well. We get this a lot, loans. My plan is to borrow against this policy and specifically use it for real estate. And in a case like this, if someone states, I want to use it for real estate, or I want to use it for my business, I'm going to show models that demonstrate using that policy. We'll talk about loans a little bit as far as showing direct policy loans, and then also cash value collateral loans. I'll explain what that is. But if your plan is to use policy loans, you're going to borrow against the policy, use it like a personal line of credit. Information on that upfront is very, very helpful. We don't have to have all the exact details. I plan on taking a $100,000 loan, then a $500,000 loan. No, some information is helpful just in order to prepare models so you can have some visuals here. Or maybe the goal is future income. I want to take income from my cash value down the road and I want it to be tax-free. That has always been a huge selling point of cash value life insurance products, that I can draw down the cash value tax-free, assuming I don't mess things up. We've got content that provides details on how a policy can be messed up, and I've got to pay taxes, but maybe income is your goal down the road. And by the way, it can be all three. Maybe you don't know what you want to do, but you want the product because you see wealthy individuals, you see corporations using it, and it's something you'd like to do perhaps with excess cash. Here's what I would always ask for. And if you're working with us, you've seen this. If you're not, I would ask your agent to provide this. Ask to see options. We want to see everything up front. I'll give you a quick example as to why. There's so many games that go on in the financial services industry. Remember a couple of years ago, someone had explained to me on the phone that they were working with a local agent, and the agent recommended that the consumer, the client, should not even consider putting money into their PUA rider, which is our paid up additions rider, because the fees there are excessive. Because on paper, we'll see fees of 7.5% or 10%. So the thing about the PUA rider, that is the key to maximizing the cash value. So this was a tactic used by the salesperson to say, hey, don't even consider that because look what they're charging you in terms of fees. And then typically the consumer response is, okay, thank you for sharing that with me. We don't even have to bother with that. However, if that consumer was shown options with those PUA fees that were excessively high, they would have elected that option because it would be a no-brainer. When they looked at the numbers, they would have maximum cash value there. But seeing options allows you to have transparency and it allows the numbers to speak for themselves, which is so important when we look at cash value life insurance products and the ways they can be designed. Next, company selection. This often comes up. So I always recommend one of the 4 major mutual companies, which are Mass Mutual, Guardian, New York Life, and Northwestern Mutual. The simple reason is when we look at actual performance, not illustrations, but actual results, I've seen consistency from them with respect to the highest internal rate of returns. So when someone says, hey, I'm interested in this product for cash value, and I want to maximize the cash value as much as possible, show me what I have to do that's in my control, and then what will maximize it that's outside of my control. I've got more confidence with these guys because I've seen it, to simplify. But to build on top of that, how do you take one of the major mutual companies and pair it with these 2 questions? How much and how long? Quick example. Guardian is fantastic if I want a policy where I want a lot of flexibility, where I can commit to a minimum amount and then just add additional funds into PUAs at discretion. However, the max funding period might be 10 years or less. And I can pay longer, but to really hit the sweet spot when I'm max funding it, So for example, you want to be able to pay $100,000 per year, but you only want to be billed for $10,000 per year. With Guardian, to really juice the internal rate of return, you'll find designing it where I'm only going to max fund for 5 or 10 years or somewhere in between, that will generate the highest internal rate of return. Whereas MassMutual, on the other hand, is a fantastic company. If someone said, I want to be able to pay into this policy for 30 years, and I want to be able to max fund it. I want a minimum premium, maximum PUA, and I want to continue to feed the policy. You can do that with MassMutual. Their design will accommodate that type of strategy. However, when we look at MassMutual compared to Guardian, we've got a little bit less flexibility. Specifically with the PUA rider, Guardian, remember, will allow you to commit to that minimum $10,000 and just throw excess funds into the policy whenever you want, where MassMutual is not quite as flexible. MassMutual works very, very well if you are comfortable and disciplined enough to make a one-time per year payment adjustment. And that adjustment occurs when my premium is due. And we've got content that provides full details on that. But little things like that, they're not little things, big things like that are very important when making a recommendation as far as the company is concerned. How about the product design? This one's pretty easy. So when designing the life insurance policy, I'm going to recommend the design that I've seen produce the highest cash values, the best overall results on a guaranteed and non-guaranteed basis, which is a minimum base premium, which, by the way, will minimize the commissions to an agent. And I say that because you will sometimes receive resistance when you are asking questions that result in reducing the base premium. Because what you're doing when you do that is you will see more cash value, especially up front and based on the guarantees, but you will lower the compensation to the agent you're working with. Whether you're working with us or anyone, when the base premium is reduced, the commission will be reduced. So from a transparency standpoint, that's good information to be aware of, especially if you receive resistance, and especially if it's in an aggressive manner. The MEC limit, this we're going to set at a number based on how you answer this question. So if someone said, I want the ability to pay up to $100,000 per year, I'm going to set that MEC limit at least $100,000. This way, I do not trigger a MEC, which is a taxable event. If someone has a lump sum of $1 million, and we're looking at different designs, and what generates the highest overall cash value is breaking that $1 million lump sum up over 4 payments, $250,000 per year for 4 years, guess what I'm going to do? I'm going to set the MEC limit at $250,000. How we set that MEC limit is through the death benefit primarily. So I want to solve for the minimum death benefit to minimize costs, maximize the PUA rider, which will maximize cash value. We've got a flexible PUA there. Flexibility is something that is very important to me and just about everyone we work with. The reason why is because if life happens, for better or for worse, and you need or you simply want to be able to adjust the dollar amount that you're going to pay into a policy each year, if this is flexible, you can easily bounce it up and down. So for example, if I've got a policy where I'm paying in a total, let's use the same example, of $100,000 per year, I don't want to get billed for that. I can commit to $10,000 per year and then have the option to add another $90,000 into my paid up additions rider, which will maximize my cash value. So this way, the policy never feels like a burden. And if I have a down year or I'm just dedicating my resources elsewhere, well, now I know I'm not billed for $100,000 and I can easily commit just to the $10,000 payment. And we see proof that it works. These designs with these low premiums and low commissions, we've seen them consistently deliver the strongest overall cash values to policyholders, again, based on actual results, not illustrations. Next part, loans. This is a good topic. And you'll notice all of these follow-up items tie back to these 3 questions. Usually it's questions 1 and 2, but here going through loans, it will be, how do you plan on using the policy? And from an informational standpoint, We might discuss direct policy loans, which means if you have a life insurance policy, you just plan on borrowing directly against the policy from the insurance company. What does that look like? What's the loan interest rate? What does a non-direct recognition company look like compared to a direct recognition company? Get that question quite a bit. Or a cash value line of credit. I like to refer to this as a cash value collateral loan. Perhaps that's an option you'd like to see. This is a nice option as I can assign my cash value as collateral to a bank. They'll give me a line of credit, typically using 95% of my cash value as the total line. It's a nice option. A lot of individuals like that. However, some prefer direct policy loans. Some like to review the rates. Some prefer working with a bank because they can easily classify it as a business loan. Just little things to be aware of. And as we really understand what your goals are, and a lot of times we can tell just based on how you answer this question, if you say, I plan on using the policy for my business or real estate, well, a cash value line of credit, if you check off that this is for a business loan with a bank, assuming it is a business loan for business purposes, that makes it easy to deduct the loan interest. Whereas loans against life insurance policies, direct loans that is, can be a bit more challenging to deduct the loan interest even when used for business purposes. I've seen CPAs do it successfully. However, when we look at direct policy loans and we look at the IRS language around deducting loan interest, it's typically frowned upon. So how I view that is, and what I would want to make someone aware of is, if you're deducting the loan interest from a life insurance policy with direct loans, I would consult with your CPA or tax professional first. I'd probably recommend a paper trail as well. This way, in the event you do receive a letter or call from the IRS, you can properly respond to them, or you've got everything well documented in order to prevent headaches, which no one wants that. So a little bit on loans there. And then service. And this has to do with both the insurance company and the agent or agency that you're working with. This is something that is very important to me personally. The big thing here, I'm going to start and end with two of the most important things. Number one, convenience. So with the insurance company you select, are they convenient? Meaning, are there online portals? Are there mobile apps very convenient where you can easily add money, where you can request loans? You'll typically see that with the four major mutual companies. They invest a lot into their technology. But then also with the agent or agency you're working with, is it a convenient process? Where a lot of frustration occurs in the financial services industry as a whole is consumers will often ask questions about their product and they do not get straight answers back. That results in frustration. Sometimes they fire their agent or advisor, or they file a complaint against them, and it is not fun at all. So if you're able to answer questions, we're going to hit on that shortly, but if you're able to provide convenience while keeping everything transparent to your consumer, meaning you're making life as easy for them as possible, boy, you'll be happy, your client will be happy, and things go so much smoother. I'll give you a quick example of this. When someone asks a question through an email and it requires a lengthy response, what I will do, because I don't want the, call it integrity of the message to be diluted at all, I'll put the needed information in there. However, when I'm reading it, I want to make sure that a client doesn't look at it and feel overwhelmed. So I'll break it up in bullet points perhaps. Perhaps I'll bold and highlight some of the main points that really just directly answer their question. And then if I'm reading it to myself and thinking, I don't know that this is going to make sense, or if I saw this the first time as a consumer, I might struggle to really grasp the reason why or grasp the true meaning of it. I'm going to have follow-up questions. What I'll do in that case is put a recording together. And this could be short, could be lengthy, depending on how much detail the client wants, but a recording, which is me just providing visuals, talking to the computer screen. And this way, when I send that to the client, they've got the written response with bullet points. They have the recording as well. This way, the recording is literally me talking to them and answering the question verbally. Sometimes I'll use visuals because I want to keep it very, very convenient for that client. Because if it's not, it just results in more time, more back and forth, and it frustrates people. So convenience is so important there. Policy changes. This is a big one. When changes need to be made to the policy, is the insurance company easy to work with respect to these changes? And is the agent and or agency you're working with easy to work with? Or do we just get answers such as, no, you can't do that, when you really can do something, but you have to question the insurance company, or your agent has to be able to question them, or just know how to do it on their own? But is the service there when it comes to policy changes? Response time, this one's huge. How responsive is your agent and the insurance company when issues pop up? Typically, I like a fast response time within 24 hours whenever possible. And sometimes that can just be received your email, working on it, just a response to know that my request or my email or my phone call was received, then moves on to the next step. Next step being providing the proper service. We touched on this one already, ability to answer questions clearly and accurately. Where we touched on it was with respect to answering an email with a complex question through bullet points, and then also a recording if needed, or perhaps it's just a phone call or meeting. Again, whatever makes life easy for the client from a convenience standpoint. I found breaking things up via bullet point format and then also the recordings have gone a long way, just because the client doesn't feel like they have to meet with me, discuss everything, and then remember everything. Meetings are helpful. However, recordings typically knock out about 90% of the questions that would be asked, and then we'll still meet if needed. But it definitely makes life easier for the client. It takes more time on the agent's end, but again, that shouldn't matter. It's about the client. And then the last piece here, dignity. So this with the insurance company is typically a non-issue. Working with an agent or agency though, it's important. And what I mean is allowing a consumer or client to keep their dignity. And this is something I'm extremely sensitive to, just because I think it should always be done. But a specific example here is, let's say you and I discussed policy design before, and you said, hey, Guardian's the option I want. I like the flexibility. That's the option you select. A couple months go by, you do some additional research. You've already started your policy, and you ask the question, I would have preferred Mass Mutual. Why don't we go with them? Well, we discussed it, and you preferred Guardian when we went through everything. What I don't want to do is strip someone of their dignity by stating something like, we discussed this, like you picked Guardian. Don't you remember? Here's everything we went through, and almost take up a defensive stance with you. This happens a lot in the industry, in a lot of industries, I think, when it comes to sales, but it shouldn't. A better way to approach this situation is, Mass Mutual is a good option. We can definitely revisit them. Is it okay if I send you the options we looked at initially? You might recall we looked at Mass Mutual and Guardian side by side. Remember the flexibility, how that works, and just provide some of the main points and ask questions to help the individual come to the realization, oh yeah, I do remember discussing this, and that's why I picked this option, and they don't even have to tell me. This way it makes life easy for them and they feel very comfortable. Because if I take an aggressive approach or make them feel like, I can't ask this person questions again, what's going to happen? Well, they're not going to work with me anymore. I've been on the other side of that, and that goes back to the most important thing when asking this question. If you're an agent, I would take notes on this. Empathy, having the ability to truly put yourself in the other person's shoes. When making recommendations for the company, product, everything recommendations, or just showing options, and then also communicating. Communicate with the individual in a manner that you like to be communicated with. That goes such a long way. So I hope that you found this video helpful. If you did, please hit the like button, subscribe for more, and if you have any questions, please leave them in the comments below. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.